Hello and welcome to another edition of Investor Insight, the programme designed to help you make the best investment decisions for yourself. In today's programme, we're going to look at bonds, the highly popular alternative to equities. Traditionally, bonds have been viewed as a lower risk investment in times of global economic uncertainty, and they've produced superb returns over recent years. The question now, during this period of economic crisis, is will their good run continue, or is the party over for bond investors? As interest rates remain at record lows, is the income on offer from some bonds still attractive for investors, and what are the risks? To explore this subject, we're joined by Ian Williams, CEO of Charteris and manager of the City Financial Strategic Gilt Fund, Steven Snowdon, who runs the Cames Investment Grade Corporate Bond Fund, and Mark Dampier, Hargreaves Lansdown's Head of Research. Before we proceed, though, let's go back to basics and explain what bonds are. In a nutshell, buying a bond is a way of lending money to the company or country that issues that bond. The bond is in fact the IOU from the issuer, promising to pay you a set interest rate for a period of time, at the end of which you should get back the face value, as long as the borrower can still meet their obligations and hasn't defaulted. The great appeal of bonds has been the regular, fixed level of income they provide. Once the bond has been issued, it can be bought and sold on the open market. The price is determined by supply and demand, not the face value. The income provided and the likelihood that the issuer is able to honour the obligation are key to the market price, and if the risk is seen as higher, the price will fall. There are basically two types of bonds: government bonds, where you lend money to a government, and corporate bonds, which are issued by companies to raise funds. UK government bonds are referred to as gilts. The popularity of bonds in recent years has caused prices to rise. Rising prices and a fixed level of income means that yields have fallen. The chart shown here shows the extent to which yields on UK government bonds, or gilts, and corporate bonds have fallen over recent years. The average yield on corporate bonds has fallen from a peak of around 8% in 2008 to around 4.5% today. For gilts, it's a similar story, with yields falling from around 5% in 2007 to around 2.8% today. This means the income available from gilts now stands at an historic low. But what does this all mean for investors? First, we're going to focus on gilts, which, as we've said, are bonds issued by the UK government. Mark, why have yields on gilts been driven so low?
Well, we've got a number of things going on. First of all, we've got incredibly low interest rates at the 0.5%, and they've been like that for quite a period of time. We've got effectively a number of forced buyers, if you want. The Bank of England are buying them, pension funds are buying them, banks are buying them, and then we've got the whole Eurozone crisis. So you've got across the pond money coming over into our gilt market because they're afraid of what's going on there, and that's really pushed the gilt yields way down. I mean, 10-year gilts are at about 1.6%, which is a remarkably low level when you think that UK inflation's at about 3%.
Ian, you manage a gilt fund.
Yes.
What are your views on gilts at the moment?
Exactly the same. I mean, what you're seeing is a combination of factors that have driven gilts, 5 and 10-year gilts, down to their lowest ever, to the point where they really don't represent any value really for any potential private investor that's thinking of buying them.
Are there any attractive government bonds?
I mean, you could argue that maybe Australian government bonds, hard currency bonds, maybe Canada, where there's potential for currency appreciation over a longer term, but certainly in the traditional UK, German and US markets, they're all at very elevated levels.
And what factors do you think could see yields rise?
Well, there's two main events that could cause a major collapse in the gilt market. First is the possible announcement re-signing of some sort of fiscal union between Germany, France, Spain, Italy and Holland. And there, of course, you see one of the reasons, as Mark's pointed out, that yields have been driven down so low is that the foreign central banks have been dumping Spanish and Italian government bonds and buying UK, German and US government bonds. Now, if you saw some sort of fiscal union put together, a lot of the hot money that would has flown into gilts and bunds would immediately fly back out into Spanish and Italian government bonds, because imagine being able to sell a Florida bond that yielded 1% and buy a Californian bond that yielded 6%, knowing in 3 years' time they were both going to be US Treasury bonds. So you'd see an absolute deluge of money come out of the gilt and bund market and go back into the Spanish and the Italian government bond markets if fiscal union was announced. The other thing we think that's on the horizon is we think the US housing market is going to recover, is recovering, and at some stage the Fed, or despite Ben Bernanke's promises of leaving interest rates low for a sustained period of time, we think if the housing market in the States was to recover, it would place the Fed in an impossible position where they couldn't keep interest rates at 0.5%, despite what Ben Bernanke has said. And you'd see a situation similar to 1994, where the Fed just completely changed policy without any warning, and it led to 25% drop in bonds across the board in gilts and bunds.
Yeah, I think there's a lot of asymmetric risk in the gilt market. That is, there's a lot of downside risk that gilts could actually fall 30%, but you're not going to make 30% in buying a gilt today, and there's the danger. The problem is one of timing. We don't know when any of what Ian is talking about might or might not ever happen.
Stephen, you're a corporate bond fund manager, but what are your views on gilts? Are you as cautious or as pessimistic?
I share many of the concerns Ian and Mark have articulated. However, I'm more benign about the environment. Gilts are at very low yields for very sensible reasons. Base rates in the UK aren't going to go up anytime soon, and I think what's probably caught everybody by surprise is one of the main reasons why gilts have done so well is that the amount of investable liquid sovereign bond markets have shrunk. So, historically there was maybe €2 trillion worth of Italian government bonds would be a source for cash. People feel they're risky now, so they don't want to invest. So treasuries and gilts, the great thing about the UK and the US is that they are in control of their own destiny. They are a true sovereign market. They can print their own currency, and as a result they're highly unlikely to default. And it's this flight to quality, flight to safety, which the gilt market displays as one of the primary reasons why it's done so well. Irrespective of any sort of resolution in the European scenario, you can't get away from the fact that French, Germans, Spanish, Italians are all locked into a single currency and therefore not sovereign markets, and will never display the flight to quality status that the gilt market and the treasury market has. So from a corporate bond perspective, you're looking at government bond yields at very low levels, but I think they could stay that way for several years, if not decades. And from my perspective, you're looking at a world with substantial challenges economically, challenges in Europe, we've discussed already, and as a result corporate bond spreads are very wide, and from my point of view the underlying level of the gilt market isn't a barrier or a reason not to invest.
Ian, what are your thoughts on that?
Well, if this low interest rate regime is temporary, most people seem to accept that it is. It's just a question of how temporary is temporary. If the temporary regime does last for a decade, you still wouldn't want to buy gilts, because why would you buy a gilt on a 0.5% or 1% yield when you can go and buy top quality equities like Vodafone and Glaxo on 5 and 6% yields? And if interest rates on gilts and interest rates at the Bank of England are going to stay low, that underpins the equity market at its current level, offering much better value. Equities are the best value relative to gilts they've been since the Second World War. So perversely, one of the threats to the equity market would be if gilt yields suddenly rose quite sharply, but then if gilt yields rose quite sharply, you would suffer a big capital loss in gilt. So it's a conundrum. But if we're in for a low interest rate regime for a long time, buy equities. There's still no point in buying gilts. Mark,
what are your views on the outlook for gilts? Are we in a bubble here?
Actually, I'm probably slightly more with Stephen. I think this could persist for quite some time. I've actually been saying that for the last 2 or 3 years, and with respect to a number of bond managers who have been completely wrong, and some of them have been shorting gilts for the last 2 or 3 years and have lost a lot of money in doing so. It's a big question in finance now. Everyone wants to know when do they sell their bonds and where do they go, because actually Ian's right. If the gilt market sold off really badly, and the last time it sold off like that was 1994, equities fell 20-25% as well. So it's not as easy as people think. And also that would affect corporate bonds as well, because everything tends to be priced off gilts, so corporate bonds wouldn't be a great place. So in that environment, actually, cash might be a better place to be, at least for a while. Or you, as Ian said, you look at the bond markets in Italy and Spain if there was that sort of particular reason. So it is a conundrum because no one actually knows the answer, because it's all down to timing, and that could be, as Steven said, we could be 5 or 6 years plus of very low gilt yields, in which case let's buy equities, or there's suddenly a sharp sell-off. If I knew that, we could all make a serious lot of money.
Well, on that conundrum, thank you for now. Remember, nothing said in this show should be construed as advice. If you do have any doubts about the suitability of anything discussed, then please do contact us for financial advice. Now, let's turn our attention to corporate bonds, which are loans to companies as opposed to governments. As we saw in the earlier graph, they tend to produce a higher income than gilts, and that's because they're thought to be slightly higher risk. However, the yield has also fallen over recent years. Steven, your fund invests predominantly in corporate bonds. Let's have a look at how it's performed over the last few years. The graph you're seeing now shows the performance of the Kames Investment Grade Bond Fund, which includes reinvested income. As you can see, the performance has been strong over the last 3 years after a dip between 2007 and late 2009. It's currently showing 5-year growth of over 30%, although please bear in mind that past performance is not a guide to future returns. Steven, do you think corporate bonds are good value right now?
Well, we had a discussion earlier about gilt yields, and undoubtedly they are expensive, but in my view they stay that way for a considerable time. The other element of looking at a corporate bond is the credit spread, of the extra yield you get on a corporate bond over the government rate. That's extremely attractive at the minute. We have effectively been in a 5-year bear market for corporate bonds. Credit spreads have widened and stayed very wide, volatile but stayed very wide for 5 years. And that excess yield or spread that you get on corporate bonds today is extremely attractive. And so on balance between, undoubtedly an expensive government bond market but a cheap credit market, I would say corporate bonds are good value.
And where do you think possibly the future bond opportunities are for investors?
The market always throws up new opportunities, but I think something that we particularly would specialise in is individual company opportunities. And companies are forever doing well, doing badly. There's M&A activity, new ambitions by the management team of companies. So you're forever getting companies that, from a corporate bonds perspective, either doing well or doing badly. So I think in that area that we are particularly active in. Also, we have to bear in mind that the market has been incredibly volatile over the last 2 or 3 years. Risk on, risk off is the phrase for when the markets get euphoric about perhaps a solution to the problems in Europe, or very depressed to think there's no hope. And that asset allocation has also been a very key factor in the way we've been managing our funds of late. And as a result, I think we've got great opportunities to make money in a volatile market.
Steven, we're now just going to take a look at 2 specific corporate bonds that you think are good value. The first one is issued by Center Parcs, the leader in the UK short break holiday market, with over 1.6 million visitors every year. Here's the basic information on the bond. The coupon or interest it pays is 7.239%. It matures at the end of February 2024. The current buying price is £113.99, and the yield, if held to maturity, is 5.58%. This figures the annual return on your investment if held to maturity. The yield is lower than the coupon or interest rate to reflect the fact that the bond will be redeemed at £100, the original purchase price. So there will be a guaranteed capital loss at maturity. Now, the minimum investment is £100,000, so it's out of reach of most investors, but then that's the advantage of investing in a bond fund where you can gain access to these sorts of bonds. Steven, why is this bond attractive, do you think?
I think Center Parcs is a very polarising credit, mainly because many people have been there and perhaps not enjoyed their holiday. I am a father of 3 young children, and irrespective of what you think about your holiday break at Center Parcs, it's incredibly popular. Their occupancy levels are extraordinarily high. And if anything, it's reasonably recession-proof as it's improved over the last 15, 20 years. And at least not we forget, if we get some sort of major disruption to travel, volcanic ash as an example, UK staycations will do very well. Centre Parks is a fabulous business. I'm not asking people to, when you look at investing in companies, to look at their own personal experience, but think that is this an attractive investment opportunity? And with the occupancy rates that Centre Parks achieve, it's and also I should add the asset backing of Centre Parks. If you buy that Centre Parks bond, you have first call in the worst case scenario on the assets of the company. So therefore you can sell the assets and recover your cash. It's a very attractive opportunity, very strong yield for a what I consider a very steady business.
Now, the second bond you want to highlight is Virgin Media, which is one of the UK's leading providers of telephone, television and broadband internet services. The coupon or interest is 5.5%. It matures on the 15th of February 2021. The current buying price is £108.67 and the yield, if held to maturity, is currently 4.27%. Once again, the minimum investment in this bond would be £100,000. So Stephen, why is that bond in particular attractive?
If you look at our funds at Keams, a very consistent theme you see throughout is a preference for UK risk. This is a UK company servicing UK customers with sterling revenues, and it's a very attractive place for us to be at the minute. The great thing about this bond is, again, is it's secured on the assets. It's a senior secured obligation. So in the very unlikely event that people stop watching the telly or surfing the net, then you do have first call on the assets, particularly the fibre network. So it's a very attractive business from our perspective. I think if the European concerns continue to grow, I think what you'll find is internationally investors are going to be looking for more and more safer assets, and something like a quasi-utility player within the UK would certainly be top of that list.
Is the income attractive from this bond?
I completely think, absolutely do believe they are. We have to bear in mind, while gilt yields and corporate bond yields have undoubtedly fallen over the last 5 years, base rates in the UK are at 0.5% and highly unlikely to rise anytime soon. So within that context, I think the yield is very attractive.
Are there any corporate bonds you've been moving away from?
Yeah, I've mentioned before that we like UK risk, but that doesn't mean that we are blind buyers of everything UK. So a telecom type name like British Telecom is a bond that we don't own at the minute. I mean, we think BT is a great company. However, they have a lot of debt maturing over the next couple of years, and they have been completely right not to refinance that debt too early as yields have fallen. But you can sometimes be too clever, and if they leave it too long and the market is in a downturn or weak at a particular point in time, they might have to pay up considerably to issue their debt. And as a result, we are expecting them to issue debt shortly, and if they are unlucky, they might have to pay handsomely for that. That has the impact of driving down the price of existing bonds. So from our perspective, we like the company, but we think there's a better opportunity to buy BT bonds.
Ian, what are your views on corporate bonds?
Well, the widening out the corporate bond spread is the same of the story as the underperformance of equities against gilts. It's the risk off trade. Since the crash in 2007, institutional investors, as distinct from private investors, institutional investors have been de-risking their portfolios. So they've been tending to disinvest from anything corporate, be it a corporate equity or a corporate bond, and tending to invest in government bonds because government bonds are perceived to be safer. Now what this has done is driven the relative values between corporate sector and the government sector to almost record levels. Now, within the corporate sector, the terms for switching gilts and virtually any other form of fixed interest actually into equities is the best since the Second World War. So we would think that for the corporate bond spread to narrow, the investors have got to take a more risk-on view of the world. If they take a more risk-on view of the world, equities will do much better than corporate bonds. And the other advantage of equities is, because they're on similar sorts of yields, is that the dividend income on equities will grow over time as the companies will increase their dividends, where the dividend on any form of fixed interest is fixed for for the life of the bond.
Is that where people should be investing for income then?
We think so, yeah. That's what we're doing for our private clients. We're keeping our exposure to all types of fixed income to the absolute minimum, and we're buying high quality blue chip equities on higher yields with growing income and the prospect of some sort of quite substantial, we think, in the future capital gain, as opposed to an almost certain capital loss at some stage on all forms of fixed interest, as and when interest rates rise. Now, we all agree that the interest rate regime at 0.5% is temporary. What we're disagreeing on is how temporary is temporary. It's purely a timing issue, but at some stage, interest rates are not going to stay at 0.5% forever. They're going to rise, and when they do, all types of fixed income are going to suffer capital losses, but not necessarily equities. And if, to go back to Mark's point, if we saw a sudden rise in gilt yields, I see a sudden drop in the price, you might well see a simultaneously drop in the equity market, because it would react badly, possibly badly. But the valuation levels are so compelling that the equity market could absorb a rise in gilt yields. And also, if gilts went down, they'll stay down, whereas equities went down on the back of gilts going down, there's a more than sporting chance they'll recover.
Mark, what do you think?
I think corporate bonds actually do offer pretty good value at the moment. It rather depends, of course, what we said earlier on about the gilt market, because a bear market in gilts would undoubtedly cause problems to corporate bonds. But at the moment, you can pick up yields of 5-6%, and under a SIP and an ISA, that's all tax-free. So that's not bad. I completely agree with Ian. I mean, I'm a great equity income fan, but within my own portfolio, I'm holding both, because I think both offer a particularly good value at the present time. So it's not one or the other. I'm mixing the two up. But I do agree with Ian that you do have to have a very close eye to what's going on in the market. No investment is a sort of, I'll buy it and leave it. But in particular now, I think you've got to have a really keen idea of what's going on and be alive to what's going on, because you may well have to change those investments at some stage. It's one of timing, and that's the problem. I can't give you that timing right now.
So what role do you think corporate bonds can play in an investor's portfolio?
Well, generally speaking, over the last couple of years, they've been considerably less volatile than equities, whereas the equity market's moved up and down 10-15%. Corporate bonds generally have not done that, and they've given you that steady income at the same time. So they're reducing the volatility of your overall portfolio. So that's where I think they've worked extremely well. And actually capital values have been rising as well. So you've actually had a 6-7% income, and quite often 3-4% on the capital as well. Well, given an inflation environment of 2.5-3%, you've actually been able to achieve a real return of 5 or 6%. But that won't last, and that's what you need to be careful of. Don't assume that what we have now is going to last for the next 20 years, because it isn't.
Thanks, Mark. Now, we've analysed the outlook for corporate and government bonds, but now let's look at what investors can actually do. Mark, what types of funds do you think investors should be considering?
Well, if you're looking at corporate bond funds, I tend to favour a more strategic type of bond fund where the fund manager has a full range of corporates. What he can do, he can go into high yield, he can go into investment grade, he can go into government gilts as well. Unfortunately, not enough of the bond managers went into government gilts when I think they should have done, but they do have that kind of that flexibility. So I think that's really quite useful. And again, although the yields will vary a bit more because each asset class will pay less or more, you can still get 5 or 6% on that. In addition, now the bond market is opening up to retail clients. You heard earlier that the minimums on some of the bonds were £100,000. Well, now we're offering, retail clients are now being offered to buy single bonds, so they can buy £2,000 or £3,000. Bear in mind, though, of course, there's more risk in buying a single bond than buying Steven's fund, which will have 80 or 90 plus holdings. So that's where you take the risk, but you know exactly where you are if you buy a single bond fund. If it's at a pound, and providing it pays out, you'll get that pound back in 5 years, 7 years' time, whenever it matures, and you'll get the income in the meantime.
So just tell me a little bit more about the different types of bonds then. What is high yield? What is investment grade?
Well, high yield is really just the more risky companies. So it divides into a sort of a strong company with great credit. Well, but you won't get such a good rate of return. You might get 4% or 5% sort of fund, sort of stuff that Steven was talking about, or a company which isn't got nearly such good credit. So the possibility that you might not get your money back therefore you get a much higher yield, in which case you might get 7 or 8% in that. But that's the risk you take. So you have to decide where you are on that spectrum. If you go to a strategic fund manager, he will he'll change that mix according to where he sees the best value, effectively.
Okay. Now, anyone looking to invest in new corporate bond launches can register for free email alerts on the Hargreaves Lansdown website. Once signed up, we'll inform you of any corporate bond launches available to retail investors through Hargreaves Lansdown as soon as applications open. Mark, returning to gilts briefly, is there any way investors can make money?
Well, clearly, if gilts carry on doing well, you'll make some money. But if you look, as we said earlier, if you take a 10-year gilt at 1.6%, well, I suppose the yield could drop. If the Eurozone problems get even worse, it is possible that the gilt drops to 1% or lower. I mean, we saw it in Japan, and people thought that the Japanese bonds were expensive at 1.5, and they went under 1, and therefore you'd make a capital gain on that. So it really depends on how depressed you feel about the world, and whether you think they're value. But I go back to the fact that there's less to go for, considerably less to go for in buying a gilt today than there was 5 or 6 years ago, and the risk is that much greater. I think what may well happen, though, is we just get a situation, as Steven said, where it just persists that the gilt yields vary between, 1.5% and 2%. Nothing much happens for quite some time, in which case fixed interest still offers, or corporate bonds, I think, offer great value. I still can't bring myself to suggest gilts at 1.5% when I'm losing money because inflation's running at 2.5%. Why not buy a corporate bond giving me 5 or 6?
Ian, what are your thoughts on this?
Well, very much the same. I mean, the only thing I'd say about Japan is Japanese government bonds, the yields were very low for a long period of time, but Japanese inflation was negative. So if the bond yielded 1% and Japanese core inflation was running at -1%, you were getting a real yield of 2%. Over here, UK seems to have perennial inflation problem. So you've got these yields now down at 1.6%, but you've still got inflation coming in at nearly 3%. And so there's no, you're losing money in real terms. There's even worse value in index-linked gilts than there is in conventional gilts. They're even more overpriced and not offering the inflation hedge that they're supposed to hedge at this current level, because the real yields have disappeared. And we come back to this big $64,000 question: how temporary is this ultra-low interest regime? And just a little warning, in June, the Spanish Prime Minister made a comment that they couldn't live with these 7% bond yields, and that they were ready to sign up for fiscal union. And within 3 weeks, the 30-year German government bond lost 20 points in price, which is about 12% in value, on the prospect that there may be some sort of fiscal union on the cards. So they're not without risk. I mean, so a so-called ultra-safe German government bond lost 12% of its value in 3 weeks. That's the sort of risk, that the downside risk that Mark was referring to when he said the risks are asymmetric. And so you have to bear in mind that there are freakishly low levels of these yields, and there's a lot more risk to your capital on the downside than there is the prospect of making capital gains.
Mark, what about people approaching retirement? How do gilt yields affect them, and what can they do?
Well, first of all, that some may well have a sort of automatic option on their pensions, which is called lifestyling, which actually switches their money automatically into gilts, basically on the basis that these are low-risk investments. I would just say that after our chat over the last half an hour, I wouldn't suggest they're necessarily low risk. So people want to take a more active approach to their pension and look very carefully. Don't imagine that some automatic switching is necessarily a good idea for you. Those actually at retirement then really have the question of, do they buy an annuity? That question really depends partly on the amount of money they have. Some people don't have the choice simply because the pension pot they have is too small. And if anything, it suggests you want to try and get your pot as big as possible, because then you'll have more choice. If you only have a few £1,000s, then the annuity may be the only answer. But if you have much larger amounts of money, then a drawdown plan whereby you don't take an annuity, but you actually invest. You invest in the sort of things that Ian was talking about, into equity income funds, the Vodafones of this world, providing 5-6% yields, would actually give you probably a better income than the annuity rate right now. And then you'd have the option maybe of switching into an annuity at a later date. but you really do need to look very carefully at your own particular background to answer that question directly. It's very hard to generalise.
Thanks, Mark, and thank you to all our guests. Now, if you're approaching retirement and you're worried about how the performance of bonds could affect you, download your free action pack. It'll tell you how you could invest in the lead up to retirement and how you can maximise the income you receive from your pension. To get your copy, just click on the link to the right of this video. Well, that's all for this edition of Investor Insight. Thanks for watching. Bye-bye.